On behalf of the Councils of Real Estate, welcome to this presentation of data centers. Keep your head in the cloud. Thank you for joining us. I'm Anthony Delapelle, CRE, 2024 Global Chair of the Councils of Real Estate, and the Managing Shareholder with the law firm McCurdy, Risk & Olson & Delapelle in Northern New Jersey. Councils of Real Estate is a distinguished international group of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in more than 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. Let's recognize our 2024 sponsors: USAC Real Estate, Capright, Equus Capital Partners, J.P. Wygand and Sons, McCurdy, Risk & Olson Delapelle, Tristan Capital Partners, Relp, WPJ McCarthy and Company, and Barbara and Steve Leader, CRE Emeritus. Thank you for your support. Before we begin, I would like to offer you a free digital subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. It's been named one of the top 10 essential real estate publications in the United States. Please visit cre.org/REI to subscribe. You're encouraged to utilize the Q&A feature during today's program. Should you wish to submit a question, your participation is welcomed, and we'll answer as many questions as time allows. I'd now like to introduce today's moderator, Miles Liu Jr., CRE, Vice Chairman of Newmark. Miles is recognized for his work in market analysis, financial modeling, risk assessment, and due diligence for data center and life science assets. Miles was invited to membership in the Councils in 2017, and I'm thrilled to hand it over to him today and thank him for leading this presentation. Miles, welcome.
Thank you, Anthony. I really appreciate it. And thank you everyone for joining. I'm going to start off right away. We only have 1 hour. So, data centers have come a long way. Once considered energy hubs, data centers are now the factories of tomorrow. IoT, AI, machine learning, virtual reality, autonomous cars, and 5G wireless have all been the drivers for this demand. In fact, no other asset class has the global reach, growth projections, and investor appetite like data centers. Established data center investors are now finding it harder to compete as several new and well-capitalized investors are entering the market, such as sovereign wealth funds, infrastructure funds, and real estate funds. But there are now concerns over inflation risks, power shortages, land scarcity, and growing regulatory hurdles. With the emergence of edge computing and the race to build hyperscale data centers, how is this industry evolving? On this panel, we will discuss the trends in the capital markets, talk about the various growth strategies, and then find out what headwinds or tailwinds are expected in the near future, and then we'll open the floor for questions. So let's get started and let the panelists introduce themselves. We'll start with Kristina Metzger.
Great. Well, good morning, Miles, and thank you for having me today. Happy to be a resource to the participants on the call. As mentioned, my name is Kristina Metzger. I've been exclusively focused on the data center sector now for over 15 years, and I lead a team of professionals across the United States and Canada, really focused on the capitalization, acquisition, and disposition of data center land developments and assets. And over the past 2 years, 3 years, my team and I have capitalized over $5 billion in data center assets. And last year, I'm proud to say that we were responsible for over 80% of intermediated asset sales as reported by REA.
Congratulations. Okay, let's start with Cecile Baker.
Thanks, Miles. I will get my technical act together. So thanks for having me. I'm Cecile Baker. I head up the leverage finance team at TD Securities, covering the communications, media, and technology spaces. And for TD, that does include the data center space. I have been at TD in this position for over 10 years, and my overall career trajectory is deep in the telecom space. TD, for those of you that aren't familiar with us, is a full-service investment bank. We're headquartered in New York City, and we've got a large team of professionals focused on the data center space. I focus on debt raising and my team is focused on raising bank financing, high yield TLB financing for our clients. Our involvement in the data center space goes back quite a bit. We started with some of the early management teams, including CyrusOne, also led the LBO financing for Vantage, where Sharif is now. Most recently, have been very active raising capital for the likes of CyrusOne, Switch, DataBank, Edge Connects, etc. I'll leave it at that.
Good. Thank you. Thank you very much. Okay. Next is Sharif Metwalli.
Thanks, Miles, and good morning, everyone. So Sharif Metwalli, I am Global CFO for Vantage Data Centers. Vantage Data Centers is a hyperscale-focused data center operator where we provide our customers certainty of power, cooling, and physical security. We have a platform across 5 continents, 20 markets, and 34 campuses. We have the ability to deliver over 2 gigawatts of potential capacity. We focus really on the hyperscale customers that are out there. I've been with Vantage for 6 years, based in Denver, Colorado.
Great. Okay. And last but not least, John Atkin.
Thanks. I'm John Atkin. I head the investment research team at RBC, focusing globally on digital infrastructure. So that would be mobile infrastructure, such as towers, rooftops, small cells, bandwidth infrastructure, fiber primarily, and then cloud, data, AI infrastructure, which would be data centers. So broad-based, probably spend most of my time on data centers lately, and happy to hit on any topic that you would like to address during the hour that we have together.
Yeah, thanks, John. Okay, and my name is Miles Liu. I'm with Newmark. I've been in commercial real estate for 30 years. Been focusing on data centers over the last 20 years, and have completed assignments over the last 12 months on 6 continents, and that total valuation is over $85 billion US dollars in terms of valuations. Okay. So let's get started, and let's talk about the latest trends in the market, and we'll start with John Atkin. So earlier this year, the number of hyperscale data centers passed the milestone mark of 1,000 worldwide. In a recent report by Synergy Research, the capacity of hyperscale data centers around the world doubled in the last 4 years, and this same growth rate is expected to continue through the next decade. So John, you've consistently ranked #1 as a Wall Street analyst covering communications infrastructure, and have been covering this space for a couple of decades. While this growth seems impressive, some of us might be wondering if it's sustainable. Could you explain what factors are driving this rapid expansion, and whether we can realistically expect the same pace to continue for the next decade?
Maybe I'll answer that in the context of prior cycles. So you've had a lot of demand over more than 20 years into this sector. At one point, it was driven by social networking, primarily Facebook. But before that, it's been enterprises of all types, archiving requirements, the desire to kind of outsource your IT and no longer operate your own data centers has driven demand for third-party developers, as well as driven a lot of sale leaseback deals. A lot of that continues to this day. But what I think drove the growth would be primarily social networking. If you go back to kind of the 2005 timeframe onward, and then cloud, initially Amazon, and then Microsoft, and then Google, Oracle, and so forth. But cloud really kind of joined the fray and became a leading driver, sometime around 2012 on a broad-based basis. And before that, it was Amazon. A lot of this has happened within data center campuses that these hyperscalers have built on their own, but a lot of it is driven demand for third-party developers that can often do it faster and in a more focused way than what these companies can do using their own balance sheets. And what you've seen is that growth continues. It could be social networking, cloud, e-commerce, digital content, what have you, as well as machine learning, which has been a big part of the use cases, I'd say, since 2016. what is now driving this next leg of growth, pretty much for most of 2023 and continuing on through 2024, would be generative AI. I do see it as sustainable, and if I compare it with prior cycles, back when it was cloud as the primary driver, the demand was consistent, but it did sometimes kind of plateau or take a little bit of a pause. So you went through periods of digestion where leasing wasn't necessarily up and to the right every single year. And then you had a lot of competitive entry into the sector from merchant developers and even new data center platforms that with capital, with expertise, could get the land, could get the power, could get the fiber and enter this business. And at times that led to not just an equilibrium of demand and supply, but maybe even an oversupply. So pricing in major markets across Europe and the US plateaued or even declined as we went through aggressive development coupled with demand, while strong, that was not always consistent. With AI, I see it differently for a couple of reasons. One is I think the demand is going to be at elevated levels for the next 2 years. Companies like Meta, Oracle, Google, Microsoft, Amazon, and others have really reiterated that, even on their most recent investor calls, that there's going to be elevated data center demand. And then energy is kind of the new element here, which has become the pain point, I'd say, and kind of the long pole in the tent in slowing the deployment of capital. Energy generation sometimes, but more consistently, it's been energy transmission that I think serves as a barrier to entry. And at least in major markets where most of these cloud clusters and where a lot of the emerging AI clusters are developing, that is going to contribute, I think, to a very favorable environment in terms of continued rent growth. Let me stop there and let you either follow up or move on to the next topic.
Yeah, no, that was a good overview, because we're going to be talking about, the challenges that we have in our sector, which is, interest rate volatility, inflation risk, supply chain disruptions, limited power availability, land scarcity, evolving regulations, and, pressure to operate sustainably. So, but let's talk about, market growth and investments and turn over to Kristina. This rapid expansion of data center market has certainly captured the attention of investors worldwide, as John alluded to. With many new projects announced almost every week, it's clear that data centers are seen as a lucrative opportunity. But what exactly is driving this investor enthusiasm? Let's dive deeper and explore this investment landscape around data centers and ask you, Kristina. You lead the data center capital market team at CBRE, and I know you spend 100% of your time advising domestic and offshore investors in dispositions and acquisitions across North America. So how do investors look at data centers, and comment on why data centers are attractive investments, but also talk about the risks of investing in data centers?
Great. Well, thank you, Miles. Yeah, I think that the good news is that we're seeing increased investor demand across the risk spectrum, and there's no sign of that slowing down for the foreseeable future. So our team puts out an annual investor sentiment report where we survey the most active institutional real estate infrastructure investors globally on their preferences for the sector, stated interest, assets under management, and where they see that going for the foreseeable future. And in the just released report that came out just a few months ago, you'll see that 97% of respondents, virtually everyone, intends to increase their investment in the data center sector. And that's up from 89% last year. So many of these groups are already invested in the sector, but most all have intentions to get into the sector if they're not there already today. And the reason for this is we'll talk about this last on the call, but the fundamentals are incredibly positive, particularly as you contrast them to more traditional asset classes. So right now in the data center sector, you're seeing insatiable demand from largely a handful of the highest credit, most financially sound global institutions. Global supply, very low, and the ability for new supply to come online constrained for many of the reasons that you mentioned and John mentioned, from a supply chain constraints, just availability and access to power, land in many of the major markets and so forth. And so as a result, vacancy is at a historic low. National vacancy sits below 3%, and many of the major markets below 1%. And so naturally, you have heavy demand, low supply, difficulty of bringing new supply to the market. We're seeing very positive rental growth, which is attractive from an investment basis, that you can see the growth and success over time. And when you contrast that to something more from a traditional real estate perspective, like office, where fundamentals remain a little less certain, right? You've got abundance of supply, the demand profile is not there. You can understand why many of these investors are looking to pivot allocations now and into the future into some of these newer age asset types, or ones where the fundamentals remain a bit more robust. And what's exciting, I think, is we look at the survey that we send out, and the groups that we're surveying are, the largest real estate infrastructure investors globally. So we're talking billions upon billions in assets under management. And you ask them, what percent are data centers of assets under management today? For almost 40% of it, it's less than 5%, meaning that data centers currently are such a nominal percentage of the overall pool of investment. But when you ask them, where do they see data centers as a percentage of investment 5 years from now, less than 8% think that it will only be 5% in the future. And each percentage increment that they're moving up that spectrum is billions and billions of dollars in investment, which is great because we need it. You'll hear from Cecile and Sharif, these are capital intensive investments, but there is a fundamental shift in the real estate and infrastructure landscape in investment into the data center sector. And we see no signs of that slowing for the foreseeable future.
Good, thank you. A key issue across commercial real estate has been the cost and availability of debt financing. And, Cecile, you financed many of the data center portfolios, including Align, Vantage, Stack, EdgeConneX, and QTS, to name a few. How does the current activity in the private credit compare to traditional bank lending, especially regarding terms and covenants?
Sure, happy to speak to that. So the vast majority of the activity that we're involved with is with a combination of traditional banks as well as increasingly institutional investors that are looking to invest in this space via senior secured debt. The availability has been very good. I will note that the vast majority of the capital needs are being raised for hyperscalers, by existing platforms such as Vantage and some of the other ones you mentioned for high quality investment grade hyperscalers. So candidly, those are a little bit more straightforward. We are seeing more creative structures. As I mentioned, TD has been a real innovator in the space, originating the DevCo structure first with Aligned, and then a number of our other clients have used that structure, including Sharif at Vantage, with great success. And again, the vast majority of the committed dollars are coming from banks. I would say that what I'm seeing is banks are very much enthusiastic about the space, but increasingly we're hearing that banks have picked their horse on the operator side, and that they're looking for scale. So banking a Vantage or a Switch or a CyrusOne or QTS, right? You have a relationship, you'll have access to a wallet of capital markets activity. And so for sure, we're seeing the greatest interest and activity there. That's not to say that there aren't other up and coming operators, and there's certainly a lot of capital, as Kristina mentioned, pursuing the space. So there is no shortage of lending opportunities. I will also note for any credit or risk officers that are on the call, the vast majority of what we're seeing is demand or operators that are looking for capital in conjunction with a signed lease. So I am not seeing a whole lot of spec activity. That might be because by and large, my clients are not pursuing a lot of spec activity. They're fortunate enough to have a lot of signed leases that they're looking to finance. We do in our DevCo structure, for instance, offer the flexibility to do some spec build. And Sharif can best speak to why that type of flexibility could make sense at times. So overall, I would say, Miles, that we're seeing a lot of demand, especially as rates come down. We are a floating rate product. But the other element that we can touch upon is the availability of term out financing, and the ABS market in particular has been quite robust. And with treasuries coming down, and hopefully this afternoon we'll get more favorable news on that front. Our ABS colleagues here at TD have been very busy terming out the bank debt, and that's only a positive, right? As mentioned, the quantum of capital that's needed to finance this opportunity is large. So we all do better when there's that ability to access multiple markets.
Okay, well, we'll talk a little later about, the ABS market, but let me ask Sharif. Vantage is a major developer of hyperscale data centers worldwide, and a couple months ago, you completed a $9.2 billion equity raise to support your expansion across North America and Europe. This new funding is expected to drive an estimated $30 billion in additional development. So let me ask you, what are you seeing right now as your biggest financial constraints?
Well, now that we've raised that amount of equity, I would continue to, similar to what Cecile just said, is debt capital, right? And the quantum of debt capital that we have to raise to go along with the equity is probably our biggest constraint. Just to put it in perspective, in 2020, as a business, we raised circa, $2.2 billion of debt that year. This year, we expect to raise in the ballpark of $13 billion of debt to help fund our growth. And so, finding the pockets of capital, with the banks, terming out, bank financings that are now stabilized assets, and allowing for banks to, recycle capital has become more and more important. And so, I think there's I don't want to say a finite amount of bank capital, but there's, some limit on it. And so what tools can we then access to help banks recycle capital so that we can just keep reusing kind of the same dollars and euros and sterling over and over again. So that means, expanding the pie from a capital markets perspective, whether it's ABS, whether it's project financing, whether it's CMBS, and any other, private placement or creative solutions.
Good. Okay. Let's talk about, the data center industry being heavily reliant on skilled labor for tasks such as construction, installation, and maintenance. The industry is facing a shortage of skilled workers due to an aging workforce. So it's increasing complexity, especially amongst competing industries. And what this means is, you're going to see like higher construction costs as a result. So, with demand causing rental rates and data center land prices rising to all-time highs, what impact do you think it will have on the short-term and long-term, when we start looking at supply chain shortages and, construction costs, elevated today? Do you think rent levels are going to be the new norm?
Is that question directed to me, Miles? I didn't hear at the beginning.
Yeah.
Look,
yeah.
I think, so from a construction cost perspective, right, we have seen an inflationary environment over the last several years driven by COVID and then, supply demand dynamics that you just talked about. And we are able to pass through a lot of that increase in CapEx, to the customers because they've got such an insatiable amount of need. They need the capacity, right? They can't do it all themselves. They need the capacity, and therefore, they're willing to rent that capacity on, 15 and even 20-year leases, so that they have certainty to, both cloud and AI, capabilities or capacity for them to do what they need to do. That said, I think as an operator, we need to continue to push, our vendor relationships, whether it be GCs, whether it be electrical subcontractors, mechanical subcontractors, et cetera, that, it's just not always, up and to the right from a cost perspective, right? It's a partnership, and the pie is growing for all of us. And so, they've got to be reasonable on those, cost increases as well. And I think the last thing, sorry, is just, value engineering, right? People, and you maybe, get into this in a minute. Liquid cooling, right, is more expensive than air cooling, but there are offsetting factors that you can build into the design of your building, that brings, you know, the overall cost not going up as much as just the addition of liquid cooling, right? So there's just things that you can value engineer into the data center to help, you know, manage some of that cost increase.
Okay, yeah, and you know, when I brought up the cost part, you know, usually supply chain during COVID was, you know, the variable. It was hard to predict. Right now, the variable is power, right? So when we talk about, you know, delay times, right? We historically, you know, look at will-serve letters from the utility company as a reliable commitment on data center projects. So, you know, that underpins the financing decisions, tenant pre-leasing agreements. However, there's been instances where utility companies have been delaying power connections even after issuing these letters, creating significant uncertainty. So Cecile, as a lender, how are you adapting your risk assessment and underwriting processes in light of this new reality? Are you seeking additional guarantees from utilities, requiring developers to secure alternative power sources, or adjusting your loan terms to reflect the increased project risk associated with the potential power delays?
Yeah, it's a great question, and it's one of the first and main questions that we've been increasingly asking. As I noted, we have a strong preference to work with experienced data center operators, and generally our clients are aligned in terms of their desire to have secured power for their tenants. What historically had been will-serve arrangements, right, are increasingly needing to be negotiated, and so we've got that on our list of diligence much earlier than we would have had in the past. Candidly, in the past, we might have assumed that the power was secured and not asked too many more questions. Excuse me, thank you. But now we're increasingly asking to see that diligence much earlier in the process. We're being asked that by our risk committees, and in the deals that I've syndicated, we've literally had risk committees at other banks asked to see the actual contract. So it's a major point of diligence. We also need to understand how delays might impact the tenant lease. So I would say overall, just a lot more focus there.
Good. Okay. You know, John, maybe this is a question that you can answer, but given the increasing constraints and costs associated with traditional power sources and the growing emphasis on sustainability, we're witnessing a shift towards alternative energy solutions for data centers. However, each option presents a unique challenge and opportunity. So what are the most viable alternative energy sources for powering data centers, considering both technological feasibility and economic viability? How do you see the mix of nuclear, geothermal, natural gas, hydrogen, and other renewable sources evolving in the coming years?
I was writing down all those different sources of energy. Did you say solar as well? If you didn't, I'll add that to the mix. But I think the short answer to your question is natural gas. So viability, availability, and so forth. Everything else you mentioned, there's nothing new going on, and so you obviously, depending on where you are on the planet, there's an abundance of solar or wind, but those are intermittent, and because there is a lack of campus scale availability of like long duration energy storage, those are going to be not a viable primary source until we kind of can improve battery technology. Essentially, nuclear, exists today, and there are new projects underway. A lot of people talk about small modular reactors. I think even the most optimistic of optimists would think that's like 7 years out, 10 years out, and fraught with complications as well as cost, right? But I think for people that are truly looking at carbon-free emissions for this sector, nuclear is going to be becoming more and more part of the discussion. And companies like Microsoft and others do have their own in-house initiatives underway, but I don't think you're going to see that anytime soon. Geothermal can, depending on the location, can serve base load as well. And then hydrogen kind of somewhat further out. So a lot of different shots on goal. But what I would say is that with the race for energy accentuated by all this Gen AI demand, it probably gives natural gas a more extended period of relevance to serve the needs over the next 5 years than what one might otherwise have been the case.
Okay. And Sharif, given the persistent challenges of grid constraints and long build-out timelines, how are you navigating through these complexities? What strategies are you mitigating the risk associated with power availability and long-term investment value?
Yeah, a couple of things that we're doing. So first off, we are working into our contracts pretty significant, I'll say exceptions for lack of a better word, with the customer for delays related to power. Historically, those haven't been included in leases, but we've been able to, on occasion, get uncapped delay permits effectively from the customer. So if a utility can't provide the power, we're not on the hook. They understand, and there isn't a financial penalty. That uncapped timeline is probably unique. But we are, able to negotiate multi-year type clauses into some of our leases. I think the other thing that we are spending a lot of time on is, looking for sites where, it would be great to have power from the utility, but knowing that we have alternative or self-generation capabilities at that site in case the utility doesn't show up. So you can't be reliant on on that one single thread at the end of the day. You got to have as much confidence as possible that the power will be there in some form or fashion.
Okay. We have a question from Tazos Casinos, and he asks, and this goes back to what you brought up earlier, Cecile, where you talk about partnerships, valuing partnerships. He says, apart from the exits of land, power supply, transmission, and telco connectivity, how should a REIT think about an operator of a data center? They're thinking about this in the context of smaller, less developed markets where the Amazons of the world aren't present.
Who was that directed to?
Anybody on the panel.
I'm happy to take a stab.
The cost of land. Okay, and they also mentioned that the cost of land and buildings is relatively small compared to the cost of the hardware, and U.S. REITs are investing in the hardware as required, or is it assumed that the tenant is paying for that hardware?
Yeah, the tenant is paying for the IT gear inside the data center, or at least that's how the REITs operate. There used to be some cases, but these are not typically REIT business models where the data center operator, runs its own managed hosting or bare metal or cloud business. But, for all intents and purposes, we're talking about, they own the building, we facilitate the power, but the tenant is in charge of putting in the servers. And then as we think about land or asset value of the project, I'd say the further you are away from a major internet gateway market and where the demand is not multi-threaded, then the more risk there is, and perhaps the less that one might assume the alternative use would be. So if it's multiple cloud providers showing repeatable demand year in and year out in a particular location, that's a very different story than if you're going to the middle of nowhere on the back of one business that's maybe pursuing an AI only strategy.
Cool. Okay, thanks. And Kristina, I know you talked to a lot of investors, and last week the UK recently classified data centers as a critical national infrastructure, and they have added that to water, electricity, space, and defense. But this raises questions about the balance between security and development. So if how do you see the UK's decision influencing similar classification in other countries like the US? How does this shape the global data center landscape, particularly for investors and operators who are looking to expand internationally? Do you see these potentially regulatory, burdens, being a burden, or just adding more complexity?
Yeah, I think, and I think Sharif can probably add great context here too, but when we see these regulatory hurdles or the requirements for data to stay within country, essentially what it does is it creates greater demand for product in a given geography to meet those accommodations. So, and it adds greater certainty to the long-term viability of the data center landscape within that region. So in the United States, we've seen a lot of questions come in too around site selection and where these data centers are today and where are they going, because we're one giant country with a lot of geography to spread around, we have a little bit more flexibility where you're seeing new data centers go into what previously were secondary and more tertiary market locations. The supply is completely constrained in the primary markets, and the ability to develop and gain access to power is pushing requirements into new markets and regions. In the UK, where you have a small country within a larger landscape, there's added complexity because now you're bound by regulatory hurdles to be within a given geography, but you don't have the flexibility to go, there's only so many places that you can go. So I think it creates, greater certainty for the investor, and that there will always be a need for data center capacity in that market and region. And in theory, could create greater scarcity of product, which would only drive value. I don't know, Sharif, and you may have better perspective, I think, on just like development considerations and how you guys are thinking about regulatory hurdles in your global footprint that could add interesting context.
Yeah, I mean, look, the regulatory hurdles across EMEA is a good example of a market where, if you develop in Italy versus Germany versus, Switzerland, there's all different kinds of, permitting, regulatory requirements, et cetera, that you have to factor in. So it does create a little bit of I'll call it microclimate within each of those markets as to the level of demand and capacity needs. Reality is it's going to be our customers who drive us into certain markets when they want to deploy, cloud availability zones in that market. And so you just have to factor that into the process.
Yeah, good. Yeah, because when we think about regulatory problems, I mean, we always, you could always think about California, and there's an article in BizNow saying that California is beginning to lose its luster. Markets like Silicon Valley are now facing headwinds because of these hurdles, but also, rising costs and energy concerns are also an issue. So, as these emerging markets are vying for attention, at the same time, emerging markets are also vying for attention, offering potential benefits like lower costs, supportive regulatory environments, and access to renewable, energy sources. So this changing landscape presents both challenges and opportunities for data centers, investors, and operators. So as we navigate through this, new reality, it's crucial to reevaluate site selection strategies, investment priorities. So, can you talk, Kristina, about the site selection? What's different about, data centers versus, any other, real estate asset type?
Yeah, well, I think, first of all, the general site selection, as we think about the landscape, 10 years ago to where we are today, it's an entirely different dynamic. And so historically, site selection guidelines were largely centered around avoidance to wide area disruption and cost. So avoidance of natural hazards like hurricanes, earthquakes, tornadoes, and so forth. Keep in mind that there are absolutely data centers in regions susceptible to all of those disasters, but when given a choice, would choose to be located in a region that wasn't. And then financial considerations really drove selection, predominantly the cost of power, and then taxes, and namely sales tax being the second largest operating cost within a facility, and then just general real estate and personal property taxes. Today, though, there is such a need for capacity and demand with virtually no supply, but that the single greatest driver in selection is the access and availability to power and the timeline to development. So there's a big arms race for a speed to product and locations that we're seeing new markets and regions pop up all the time. What is interesting about it, I think, as we bring this more full circle from a real estate perspective, is that as an advisor, we're cautious to guide our clients to think through the right capitalization structure for any given market and region. And so, being on a team where we've advised on, many and most of the largest asset level capitalizations or dispositions, thinking through what that investor list looks like for, a $1 billion single tenant asset in the middle of nowhere is a little bit different than, some of our main markets. And so what remedies are investors and developers putting into those contracts, or maybe there's like a put option to the tenant or some force of crystallization that you can get out. And so we're seeing this all take place real time, but I think if you look at site selection guidelines of the past to where we are today, they changed pretty considerably. And then as a result of that, the operating structures between landlord and tenant are also taking shape considerably as well as the dollars continue to rise and, the certainty of exit remains a careful consideration. I think there's a number of people on the panel that can probably speak to this, like Cecile, how much consideration as you're looking at projects does location make to overall investment, how you're structuring that, or Sharif, I think, is how you are negotiating the contract with the tenant, and does that take shape based on location? And the answers can be very different than a private equity operator that's going to have a different exit model than like a Vantage, as an example.
Yeah, I would say for us, it's important. What's been interesting is that we've seen the development of, tier 2 market or tier 1 adjacent markets like Atlanta, right, have become much more prominent. Sharif, you were one of the early people in Atlanta. For us, those are, for banks in general, those are always going to be easier deals than, say, North Dakota, right? But as Sharif notes, a lot of this is driven by the tenants themselves, what availability zone they're solving for, what connectivity they need, latency, acceptable latency, things of that sort. Where we're seeing people get creative is perhaps around an anchor tenant, right? Increasingly, perhaps a large educational institution that might have special compute needs that might be a draw for other, might have been considered enterprise type tenants before, but all in the compute space. So that's where we see some differentiation, right? Northern Virginia, for those that don't know, is a crowded market, and most importantly, doesn't have a lot of available power in the near term. As Jonathan mentioned, transmission factors in, right? So in due course, we would all expect to see additional power come, additional supply. But for the time being, people that have capacity or release capacity coming on are doing quite well in those markets. But generally, we are seeing the evolution of the space and more tier 2 or tier 2 adjacent markets. But I would also say we're a little bit cautious, right? We don't want to find ourselves financing an asset at 80% loan to cost, 65% LTV, where there's any type of risk on the releasing, because that will impact the ability for our clients to term out our debt financing. So generally easier within our portfolio of assets, but a lot of thinking going around that. But maybe I'll turn it over to Sharif or Jonathan to speak more to that.
So I'll jump in. We've tended to focus on tier 1 and tier 2 markets more recently. If you were to call an Atlanta a tier 2 market or San Antonio a tier 2 market. It's all, to Cecile's point, driven by what is the risk associated with that market in 15 or 20 years and the deployment that the customer has. Reality is, we're a firm believer that cloud deployments aren't ever going anywhere, or the data center may not be their best and highest use cloud set of servers or capabilities, but there will be a use case for that asset for a very long time, given we believe that cloud compute isn't going anywhere, and people are continuing to do more and more there. The question becomes, is that the same story with AI? I think currently there's a belief that AI has a very long roadmap, But reality is we don't know what the world's going to look like in 20 years around AI. And so, again, different operators are going to take, different perspectives. I think, as we think about AI, well, one, we want to build a data center that is AI and cloud capable, so that if a customer wants to do AI in a data center, great. If someday they're not there anymore from an AI perspective, we can still do cloud in that same data center. We're seeing customers deploy cloud and AI in the same data center. So that's how we're attacking it. We want to be in markets where we feel really comfortable that it's always going to be a cloud market at the end of the day. But we'll take advantage of AI opportunities in those same markets.
Okay. There's a lot of emerging players. The market you talked about earlier, Cecile, was Allendale, North Dakota, right? North Dakota. That's an instance where we see new players such as blockchain companies who are trying to diversify their revenue streams to attract AI, right? We also see, a lot of the industrial REITs are coming into the space and trying to look at their inventory and see where they can, have a data center location. But, coming back to, North Dakota, there was a recent SEC filing where Applied Digital, a blockchain company who rebranded their platform to focus on AI, signed an exclusive agreement with a hyperscale company to lease space on their campus. So what are your thoughts on tertiary location? More specifically, what happens at the end of this lease? What's the highest and best use? I know earlier you said you weren't financing at these locations, but maybe Kristina, you have some thoughts about these locations, and what's important to you? Is the tenant's ability to pay rent, or with a great credit tenant, or are you looking at the location as well?
Yeah, I think short answer is it depends. I think structure, overall risk profile, a opportunity, and where I sit, we're advising the investors and operators of these sites, either in the structuring of that initial deployment with the tenant and or on the back end, like on the capitalization or exit, is how specialized is this facility, who's the underlying tenant, and what does it support? And then how is that agreement structured between the tenant will largely dictate the overall capitalization strategy, and then optimum outcome for exit. And I think as you get into these more remote locations, a lot of institutional capital that's the likely takeout for many of these offerings is not there in the same way that it would be for a primary market location where you've got significant depth and history of that market. And so you step into, a different echelon of investors that may be a little bit higher yielding. And so you just have to make sure that it's structured appropriately on the front end to accommodate it. I think from the debt side, the tenant credit and the terms of that lease are most significant. So typically, that agreement's going to sit inside of the lease term. They've got great confidence there. It's more on the equity side on, overall exit strategy. And that's where I think that coordination with the tenant, we're starting to see some very unique structures and options where the tenant very likely could be the takeout for some of those.
Okay. And it seems that these locations, they're usually reserved for, AI training. And, if we fast forward, and maybe John, maybe you have an opinion on this, but or thought on this, but, if we look at the AI cycle, what happens after, machine learning and inference modes?
Well, nobody knows how repeatable or what the growth rate will be for the AI demand longer term. I think it's interesting to kind of reflect on what Meta and Amazon and Oracle and Google and others said just on their most recent earnings calls, because they were being asked about the returns that they're seeing from what is collectively, triple digit billions of investments in AI infrastructure. And, to paraphrase what Microsoft's CFO said, as well as Meta's CEO and other executives, it's basically, we are definitely spending this amount of capital for the next, 2-3 years. There's no question about it. Can we tell you what the return is? No. Microsoft comes closest because they talk about a 7% tailwind that they're seeing. 7% of what they report as cloud revenue is attributable to AI, but it's very much TBD. And they were trying to kind of set the expectation that one should be thinking about, 5-10 year chunks of time before we see what actual business models get created and what sort of economic return there is. But for the meantime, they can afford this CapEx. If you look at cash on hand on the balance sheets of these companies and how much cash they generate in their existing businesses, they can afford to spend the CapEx, and a lot of that is going towards NVIDIA servers. So the reason nobody really knows is that, and Microsoft, as an example, might be among the first to know, because when their latest batch of let's call it H100s, which they spent quite a lot of money on a year plus ago, a lot of that's only now being deployed. And these chips have useful lives that are maybe 3-4 years. So it's in the next couple of years that these companies are going to decide for themselves and ask themselves the question, what return did we get? And are we going to replenish this CapEx for the same sort of investment? Or to Sharif's point, are we going to maybe redouble our efforts on cloud, where we can quantify what the economic return is? So difficult to know where these large campus types of investments are going to go, but clearly for the next 2-3 years, it'll be quite aggressive levels of investment. After that, it's anybody's guess. And then you mentioned the word inference, and that's different. Currently, inference is basically running a model. A lot of times that takes place exactly the same place that training takes place. In kind of a large campus environment. In some cases, it's at the edge, literally on your device, or in a Waymo car where I live in San Francisco. That's an example of inference in action. But it's yet to be determined if inference is going to be deployed at scale in, let's call it, medium-sized data centers of the type that, say, an Equinix or a CoreSite operate. Equinix has commented on this, recently, saying maybe 12-18 months down the road they'll have a better way to quantify this. But in the meantime, inference is not having a measurable separate impact on the demand environment.
Yeah. So a lot of questions come to mind. So if you or the industry doesn't know what's going to happen in 3 years' time, let's say, right? And a lot of these requirements don't require latency, but as these workloads begin to mature and they need to go into production, they need to be in a resilient facility with latency requirements. So, do you see, because right now we're witnessing large takedowns of space and power this year, 100, 200, 300 megawatt leases signed by a single tenant hyperscaler. So, fast forward, with rents increasing 30% in certain markets, I mean, are we going to see a readjustment to rent, say 5 years from now? Is demand going to continue outstripping supply?
Miles, can we ask you that, since you appraise a lot of these assets?
You're financing them. But I mean, I guess that goes back to a question too, to Kristina, that someone was asking about, cap rates. Where do you see cap rates, relative to other traditional asset types?
Yeah, I love all the difficult to answer questions that have been flying around recently. I
know. I'm trying to rush this because I'm realizing we only have 6 minutes left on this call.
And then rest growth. I think from a cap rate perspective, I'll focus on core products, because that's the most basic. So long-term leased, investment grade product in data centers. There's quite a bit of it is predominantly build-to-suits for the Google, Microsoft, Amazon of the world. In the last 24 months, the relative sales market has been fairly anemic, not for lack of investor interest, but really for lack of sellers. As we saw the run up in base indexes in the 10-year Treasury and corresponding spreads, all-in cost of debt financing had really expanded from, call it the peak in late 2021, early 2022. And as a result of the increased cost of debt financing and these acquisitions being quite sizable, most large-scale data center developments, even for a single asset, you're talking between, $500 million to $1 billion easy for where we are in the market today. That cost of debt financing placed pressure on overall equity returns and corresponding cap rates. And so we did see expansion through that time period. The market has now come in. Today is a pretty exciting day where I think, all of us are eagerly awaiting to see what will happen. And so cap rates have come in a little bit, but directionally what I would say is we're not seeing initial cap rates inside of debt coupons. So many refer to this as negative leverage, or essentially where your borrowing cost is greater than your initial yield. And so that has been largely informing poor execution where you have long-term fixed covenants with fixed rental increases, which is not too dissimilar than what you might have seen recently in like industrial product as an example. So hopefully that gives a little bit of guidance. And many owners of data center real estate are of the opinion that as the cost of debt comes in, cap rates will follow, which we generally agree with. I will say, though, that we are starting to get to a place where there's a relative value consideration taking place where, there's been a bit of a softening in the industrial market. As you contrast data centers to industrial, they're from a core product perspective, where those returns sit is weighing on overall interest into data centers as well.
Miles, I'm happy to answer the question that as to lease rates, right? We are seeing on the bank finance side, we are seeing lease rates heading up. We are also seeing escalators heading up. So I would say on that, the point about supply demand is definitely translating into better lease terms. So that is definitely something we're seeing. With rates coming down, we would expect to see, commensurate increases in valuations as well. So from that standpoint, quite healthy.
Yeah.
Okay. As these deals begin to grow, right, the pool of buyers shrinks, especially when you start looking at massive campuses, right? If you start looking at, QTS building a 10-building, 1.1 gigawatt development in north of England, for example, or, there's several other, 1 gigawatt, campuses in the US as well. But, it seems like there's, what's the exit for these developers, especially, if it's a multi-billion-dollar campus and it's part of a larger portfolio, what's the exit? Are we going to start seeing companies like, Switch, moving towards IPO discussions?
I can start with some of this. So I think you're going to see all the things is kind of my response to this. So when you look at the data center landscape, the diversity in operators is very different, and how they're building out those portfolios and what those exits might look like. We focus on the overall size and scale of some of these campus deployments, but what we guide a lot of our clients to is, don't build out a single one building, $2 billion asset, right, with one single tenant. Instead, build a campus, break that up into 4, $250 million buildings, if you will, each on its own parcel, subject to its own lease. It just provides much greater optionality in the overall capitalization from a debt and an equity perspective. When capable, that's something for groups on this call to consider when thinking about overall data center deployments of what is the right size for the market that meets the tenant's needs and where does that come together. And then for some of the larger groups, like Vantage, I think Sharif could maybe talk about this a little bit, or a Switch, or maybe an Aligned, that have these very large scale facilities, is a public exit the right exit, or what will that look like? I think, in my view, I think we'll see a little bit of everything. So, some public exits, some more private market exits, recapitalization, more institutionalization of the asset class, like you would see in office and other products. But very much welcome the comments from the panel.
Yeah, I think, Kristina, you hit it pretty spot on. I don't think there's one right solution. I think there's considerations for the different opportunities for exit. For companies like Vantage or Aligned, where it's a little bit of elephant hunting, QTS, right, with the customers. Being public could be challenging because the leasing will be there. It's just, can you predict it from quarter to quarter? You can't, right? And so, that means, if you're still in the development phase, it's hard to be a public company and give good guidance. If you're, a stabilized asset, public company, well, you don't have that volatility on leasing because you've got a stabilized portfolio, but you've got basically a 3% grower or whatever the escalator is, plus whatever operating leverage you have from revenue down to NOI and EBITDA. So is that super interesting as a public company? So I think there's going to be some mix. Maybe there's some stabilized assets and some development assets that are in there. Maybe folks decide to go down the private asset monetization. We've done that where we continue to manage the assets, but it's a different ownership group that owns stabilized assets versus development assets. So I think there's going to be a variety of things that probably transpire over the course of the next 12, 24, 36 months.
So I think we're at time. And we want to try to keep everybody on schedule so that you can go on for the rest of your day. I want to thank Miles for organizing the program, and thanks to Cecile, Sharif, Kristina, and Jonathan for your contributions and presentations today. You each exemplify the exceptional high-level thought leadership for which the Councils of Real Estate is known. Please join us as our fall series of webinars continues on October 10th with ESG, What on Earth is Happening? Until then, on behalf of the Councils of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. Have a great day.